your returns are going to come from a couple different sources, from dividends, interest, and capital gains, or capital appreciation. Like, I don't really care where it's coming from. I want to focus on what's the total return of my investment. That's great that a fund is yielding 9%, but if my total return is flat or negative after everything is factored in, like, what did that 9% yield really do for you? So yeah, we want to be careful about just looking at the yield. We want to look at the total return of your investment. And we can talk more about maybe, total return versus yield, and, creating income in retirement and how that all plays together. But I do think it's important to maybe go back to the construction process. And if, again, we're not going to choose something for the yield, which, believe it or not, I think is just more common than most people think. I think people get really hyper-focused on what's the yield of my portfolio, what's the yield of that stock or the yield of that fund. Most people just get this backwards. I think that your needs and goals should drive how you invest your money. And so if we think about it in that way, that we should let our needs and goals drive how we build our portfolio, how much risk we should take, then from there we can say, okay, we know what my needs and goals are. I know what my risk target is. Here's a kind of a simple 3-step process that I put together for how somebody can go about building a portfolio that, by the way, it's going to pay dividends. Naturally, this portfolio will pay dividends, but the dividend yield did not influence how the portfolio was constructed. But of course, it's going to pay dividends because 75% of all U.S. large cap companies pay a dividend. So if you have a properly built portfolio that's diversified, it's naturally going to pay some dividends. So to me, step one of this 3-step process is just determine what asset classes belong in your portfolio, and just keeping it simple. Through your research or through what your advisor recommends, you might determine, hey, I want exposure to U.S. stocks, international stocks, and real estate. Just really, really simple example. But step one is what asset classes belong in my portfolio based on what my financial plan says and my needs and goals and risk target. Then step two is to, the quote from Meb Faber is, we want to make sure we're buying, good asset classes or good companies at good prices. So now that we know what belongs in the portfolio, let's use our preferred valuation metric and let's determine what companies or segments inside of those broad asset classes have attractive valuations and higher future expected returns. So maybe you determine by using something like the Shiller PE ratio that small cap value stocks are undervalued and large cap growth stocks are overvalued. So as a result, you might not remove large cap growth from your portfolio entirely, but you might tilt the portfolio a little bit more towards those small cap value stocks and maybe a little less from those large cap growth stocks. So that's a decision that you can make. And then finally, once you've identified some of these, undervalued asset classes that you want to maybe overweight, then it's time to identify and implement your portfolio. What holdings are you actually going to purchase? And to determine what investment solutions you might use. You might use individual stocks or mutual funds or ETFs or a combination of all three. But regardless, your goal here is to ensure that you're getting the desired exposure to the asset classes that belong in your portfolio at the lowest cost. That's our goal there. And again, since 3 out of every 4 large cap US companies pay a regular dividend, my portfolio here, this 3-step process, this portfolio will naturally pay some regular dividends, but the dividend yield was irrelevant to me during this whole construction process.